What's up, guys? T from Focus Trades. Alright, let's talk about Iron Condors, and I'm going to explain it in a fashion that'll make it nice and simple, nice and easy to understand, and hopefully show you guys, the power and the potential behind this kind of strategy. So in this example, let's talk about the monthly SPX Iron Condor strategy, shooting for about a 20% return. Now, key features, guys, of the Iron Condor. It's simply a combination of a call spread and the put spread on the same stock, or in this example, on the same index. So what that does is that it builds a wide potential profit range around the current price, and it's one of those strategies that doesn't rely on you, the trader, picking a direction. This leaves you with multiple scenarios that are going to result in you collecting your profit, and you're going to collect your profit really whether or not the market goes up, goes down, or goes sideways. As long as it stays within the range that you built, which we'll cover here in a second, you're going to walk away with your max profit. So with all that being said, the Iron Condor strategy, when done right, can have a pretty good win rate. Now, in terms of the structure of this given Iron Condor, guys, right, as far as monthly trades go, we're looking for options that have about 30 to 45 days till expiration, and in the construction and putting together the Iron Condor, on the call side, we're looking to sell the calls that have a delta of 10, and on the put side, we're looking to sell the puts that have a delta of 10. So here's how that looks, right? We're looking at January 3rd expiration, so days till expiration, we've got about 32. And we're looking here at the SPX index, and like I mentioned, Iron Condor is pretty simple, guys, just a combination of a call spread and a put spread. So in this given example, on the call side, we're going to grab a call spread where we're selling the delta 10 calls. So in this given case, we're going all the way out to 32.25. So we're going to sell one of the 32.25 calls, and as protection, we're going to buy an even further out the money call at 32.30. We do the same thing here on the put side. We're going to sell puts, in this case the 28.85s with a delta of 10, and we are going to buy as protection one more strike further out the money. We're going to buy a 28.80 put. So we're selling the delta 10 puts, and we're buying a put as protection, and we are selling the delta 10 calls and then buying another call as protection. So with calls up here at 32.25 and puts down here at 28.85 sold, that's the wall that we build around the current price of the SPX index, right? That's our potential profit range. So if you look at this on the chart, right, and I've got a weekly chart here, guys, just so you can kind of see, the width of your potential profit range on a few different time frames. Once you get this trade on, you've sold calls up here at 32.25, you've sold the puts down there at, what was that, 28.85, and now here's how this works, right? You're not picking a market direction, you're not relying on being correct, thinking the market's going to move higher, you're not relying on being correct, thinking the market is going to move lower. Simply, you're building a wall, so to say, around the current price of the index, and here's how this works. We've got 30 days till expiration, right? Fast forward to the expiration day. As long as we close anywhere inside this range. So come expiration, which in this case is January 3rd, as long as we close anywhere above 28.85, and as long as we close anywhere below 32.25. So as long as we close anywhere, guys, inside this range. You can see that on the weekly chart. All right, we can take a look at the range here on the daily, and we'll go all the way down here to the 4-hour, and hell, let's look at the hourly, right? So we've built this, we've built this range around the current price of the index, and that's all we're looking for, is for the SPX to close anywhere inside that range come expiration, and that's what's going to leave us with our 20% return on risk. Now, for this given example, guys, it's a smaller example, but nonetheless, you're risking a little bit more than $400 to make a little bit more than $85. Now, that might not seem all that significant, but think about this here. Regardless of how many contracts you go, it's 20% return on your potential max loss. And you collect that 20% return on the capital required here as long as we close anywhere inside of this range. So you're not trying to pick a direction here. You're not trying to nail the next move to the upside. You're not trying to nail the next move to the downside. You're simply taking advantage of something that happens every single week and every single month in the options market, which is that 70 to 75% of the options you see here are going to expire worthless. So here's how you walk away with that profit, right? we put this condor on the call side, we're going to sell, and I got the wrong strikes there, guys, so just ignore that. Right? On the call side here, we are selling that 32.25 call at about $4 a piece. And we're buying, as protection, the 32.30 at about $3.50. And down here, guys, on the put side, right, we are going to sell at $28.85. We're going to buy the $28.80. And if you had taken this position this afternoon, you're shorting those puts at $8.70, and you're buying the protection put at $8.40. So the golden rule of options is how you make your profit here. And the golden rule of options is that come expiration, any put and any call out the money, right? So any put with a strike below the current price of the market and any call with a strike above the current price of the market is going to expire worthless. So let's fast forward here to January 3rd, and let's imagine that we close anywhere inside this freaking range we've built, this big-ass range. Here's how you walk away with a profit. On the call side, the calls that you shorted, the call that you bought, they're both going to zero. So you're going to collect $400+ of profit from the call that you sold. You lose $350 on the protection call you bought, and on the call side, you profit $55. Now at the same time, as long as we close above that put down there, those are both going to zero as well. So in this circumstance, you're going to collect $870 of premium from the put that you sold going to zero. You lose $840 from the put that you bought going to zero, and you make $30 on that side in between the two. This is how you make $85 of profit with only $400 of risk. All right, so one important thing to note here. Maybe you kind of picked up on this during the video, maybe you haven't yet, but on this given condor, guys, and on most condors, you have way more protection to the downside. So with the SPX index closing today at 311.14, a move above 32.25, right? A move above the call that we sold there would require the market to move over 3.5% over the next 4 weeks. Now, is that impossible? Absolutely not, right? That could definitely happen. Still, it's pretty good odds. But where we really have some pretty significant protection here is on the put side, because we're selling fucking puts all the way down to $28.85. And if you think about this, right? For the market to drop below the strike of the put that you shorted, the market would have to drop over 7.5% over the next 4 weeks. Now that is highly unlikely. Putting aside some terrible world news, some terrible economic data, right? Just some kind of black swan event, we really shouldn't expect the market to drop over 7% over the next month. So you do have way more protection to the downside than you do to the upside. But at the end of the day, guys, this isn't so much a market direction kind of trade. You're taking advantage of the fact, like I mentioned earlier, taking advantage of the fact that every single week, come expiration, 70 to 75% of the calls and 70 to 75% of the puts are going to expire worthless. So the reason that we pick the Delta 10 options on both the call side and the put side to sell for this condor is that if we pull up this tool here, right, the out the money percentage, what we're doing here, guys, is we are selling puts that have a 90% chance of going to zero. And we are selling calls that also have a 90% chance of going to zero. So you can see that in order to get this 20% return on your risk, we aren't picking a market direction. And to be completely honest, guys, you can kind of, in a lot of ways, get rid of the chart for this kind of trade. We're ignoring, not so much the price action. Not focusing so much on the price action. We're not picking a market direction. We're really looking to take advantage and exploit what happens every single week on the options chain. Majority of these options are going to zero, so when you can go far enough out the money on the call side, and you can go far enough out the money here on the put side, you're giving yourself a high probability chance of collecting your max profit. Now, to be honest here, guys, this is a pretty good risk reward, right? If you take a $400 hit, the market has to move significantly against you. If you've spent time buying calls, if you've spent time buying puts, you know how easy things go against you, right? You buy a call and it doesn't go up enough the next day, so you lose value, right? You buy a put and the market consolidates for a day and your put rapidly loses value. So what typically kicks your ass, which is the premium decay in options, these kinds of strategies like the Iron Condor and the other option strategies that we focus on at Focus Trades, as far as the swing trading side of things goes, premium decay becomes your best friend. You're kind of flipping the tables, and now the premium decay, which used to leave you frustrated and which used to leave you with those crazy ups and downs and that crazy inconsistency, all of a sudden, man, that premium decay is working in your favor. So an Iron Condor, guys, is a really simple strategy that gives you a wide range to potentially walk away with a profit, and you don't got to sit here and babysit this shit. Right? We've got puts all the way down here we shorted. We've got calls all the way up here we shorted. You don't got to sit here every hour staring at the market. You're looking to take advantage of the way that options work, and that's what can create, in addition to your more aggressive trading, that's what can create consistent income as an options trader. So if you enjoyed this video, guys, like and subscribe, and you can check out the link to the Focus Trades group in the description of this video. I hope you enjoyed, and I'll see you in the next one.